The world of global gold reserves. The global financial system rests on a foundation that is rarely seen and often misunderstood. Deep beneath the bustling streets of major metropolitan centers, guarded by military-grade security and centuries of legal precedent, lies the physical bedrock of global wealth. This is the secretive world of global gold reserves. It is an environment where ancient metals intersect with modern geopolitics. It is a world where accounting anomalies mask trillions of dollars in sovereign value. Here, the physical movement of a single gold bar can signal a seismic shift in the balance of international power. Gold has captivated human civilization for millennia. It is virtually indestructible. It is infinitely malleable. It is uniquely scarce. For modern nation-states, however, gold represents far more than a glittering relic of a bygone era. It serves as a strategic national reserve asset. It is the ultimate financial safe haven. Gold carries no credit risk. It is nobody else's liability. Unlike fiat currencies, which can be printed in unlimited quantities by central banks, the physical supply of gold grows by only a fraction of a percent each year through laborious extraction from the earth. This physical reality makes gold an unparalleled hedge against inflation and currency debasement. To understand how central banks manage this precious metal today, and why they are currently accumulating it at the fastest pace in modern history, one must journey back in time. The timeline of gold is a continuous thread of human economic evolution. Tracing this timeline provides the necessary context to decipher the complex geopolitical maneuvers occurring in the present day. Chapter 1. The Origins of the Golden Anchor. The modern relationship between sovereign nations and gold reserves began somewhat by accident in the early 18th century. In the year 1717, the renowned physicist and mathematician Sir Isaac Newton served as the master of the Royal Mint in Great Britain. In an attempt to stabilize the nation's coinage, Newton set the official exchange rate of silver to gold. He slightly overvalued the gold guinea, setting its price at 21 shillings. This single mathematical calculation inadvertently drove silver out of circulation. It placed Great Britain on a de facto gold standard. Because Britain was rapidly becoming the world's leading financial and commercial power, this accidental monetary standard eventually served as the blueprint for the entire global economy. By the late 19th century, the classical gold standard was firmly established. Nations around the world committed to fixing the prices of their domestic currencies to a specific, unchanging amount of gold. This system rigidly constrained governments from printing excessive amounts of money. It fostered a period of unprecedented global economic growth. It allowed for relatively free trade and stable capital flows. The gold standard acted as a golden anchor, ensuring that paper money was always backed by tangible, physical wealth. However, the rigid nature of this golden anchor also bred severe economic fragility. The inflexibility of the gold standard proved disastrous during the Great Depression of the 1930s. To stimulate the collapsing economy, governments realized they needed the power to expand the money supply. They needed to break free from the constraints of physical metal. In the United States, this realization led to drastic political action. On April 5, 1933, President Franklin D. Roosevelt signed Executive Order 6102.1. This historic executive order explicitly forbade the hoarding of gold coin, bullion, and certificates within the continental United States. It effectively forced American citizens to surrender their private wealth to the federal government. The government compensated citizens at a fixed price of $20.67 per troy ounce. The following year, the United States Congress passed the Gold Reserve Act of 1934.11. This sweeping legislation required the Federal Reserve System to transfer ownership of all its physical gold to the Department of the Treasury. The Federal Reserve was issued paper gold certificates in exchange. Immediately after securing the nation's precious metal, the federal government officially changed the statutory price of gold. They raised it from $20.67 to $35 per ounce. This deliberate devaluation of the United States dollar instantly enriched the government's balance sheet. It also heavily incentivized gold miners worldwide to expand production and ship their gold to the United States for a higher payout. A massive influx of foreign gold began to flood into the country. The federal government quickly realized it needed a new, impenetrable fortress to house this growing national treasure. Chapter 2: Forging the Global Vaults. To secure the rapidly expanding gold reserves, the United States Treasury Department constructed the United States Bullion Depository in 1936.13. This facility is located adjacent to an active United States Army post in Kentucky. It is known to the world colloquially as Fort Knox. The inland location was chosen strategically. The goal was to move the nation's gold reserves away from coastal cities, which were considered highly vulnerable to foreign military attacks. The first shipments of gold arrived at Fort Knox in 1937. The metal was transported via heavily guarded United States mail trains. Fort Knox eventually became the largest single repository of American sovereign gold. Today, it holds over 147 million ounces of the precious metal. The facility is not a production mint. It is strictly a storage fortress. It operates under immense security provided by the United States Mint Police, bolstered by the proximity of the surrounding military base. As the 1930s drew to a close, the threat of global war became a terrifying reality. European nations watched the geopolitical landscape deteriorate. Terrified of invasion and the potential looting of their national treasuries, these countries desperately sought a safe haven for their sovereign gold reserves. The United States, protected by two vast oceans, was the logical choice. Vast shipments of European gold crossed the Atlantic Ocean during and immediately after the Second World War. However, this foreign gold did not go to Fort Knox. Fort Knox was reserved exclusively for United States Treasury assets. Instead, the foreign metal was directed to the basement of a massive, Renaissance-style building in Lower Manhattan. The Federal Reserve Bank of New York had been completed in the early 1920s. Its underground gold vault was an engineering marvel. Resting directly on the solid bedrock of Manhattan Island, the vault sits 80 feet below street level and 50 feet below sea level. The bedrock foundation is crucial, as it is the only surface capable of supporting the immense, concentrated weight of thousands of tons of gold. The primary entry to this subterranean fortress is not a traditional bank door. It is a 90-ton steel cylinder set within a 140-ton steel and concrete frame. When the cylinder is rotated into the closed position, it creates a completely airtight and watertight seal. Time clocks automatically lock the vault until the following business day, and armed Federal Reserve Police provide continuous surveillance. This Manhattan vault quickly became the premier global hub for international gold storage. Foreign central banks valued the physical security of the facility. They also valued the political stability of the United States. Furthermore, there was immense convenience in having sovereign assets located in the heart of the world's emerging financial capital. Across the Atlantic Ocean, the Bank of England maintained its historical role as another vital node in the global geography of gold. Much like the New York Fed, the Bank of England's massive underground vaults in London primarily hold gold on behalf of foreign central banks and similar institutions. Only a small fraction of the gold in the London vaults belongs to the United Kingdom's own treasury. London had long been the undisputed global center for over-the-counter gold trading. Keeping physical gold at the Bank of England provided central banks with immediate access to massive market liquidity. Chapter 3: The Bretton Woods Era and the Illusion of Movement. As the Second World War concluded, the international community gathered to rebuild the shattered global economy. In July of 1944, delegates from 44 nations convened at a hotel in Bretton Woods, New Hampshire. They established a new international monetary framework that placed the United States dollar at the absolute center of global trade. Under the Bretton Woods Agreement, foreign currencies were pegged to the dollar. The dollar, in turn, was officially pegged to gold at a fixed rate of $35 per ounce. Because the United States held the vast majority of the world's official gold reserves at the time, the system functioned incredibly smoothly for over a decade. During this era, the Federal Reserve Bank of New York cemented its role as the world's most important custodial vault. It is crucial to clarify a common misconception regarding this facility. The Federal Reserve does not own the gold in its Manhattan vault. It acts strictly as a guardian and custodian. It holds the gold on behalf of account holders. These account holders include the United States government, foreign governments, other central banks, and official international organizations. No individuals or private sector commercial entities are permitted to store gold in the vault. With the Bretton Woods system relying heavily on international gold settlements to balance trade deficits, central banks needed a way to execute transactions. Physically shipping heavy metal across oceans on boats was slow, dangerous, and expensive. The solution was a brilliant logistical and administrative innovation known as earmarking. Earmarking is the process of transferring the legal ownership of gold without actually moving it outside the walls of the vault. Inside the Federal Reserve Bank of New York, gold is housed in 122 individually numbered lockers or compartments. These lockers are numbered rather than named. This practice ensures the strict confidentiality of the sovereign account holders. When one nation needs to settle a financial balance or sell gold to another nation, physical transportation out of the building is bypassed entirely. Instead, a highly choreographed internal vault transfer takes place. Security protocols dictate that a specific control group must be present whenever a compartment is opened or gold is moved. This group consists of 3 representatives. 2 members are from the gold vault staff, and 1 member is from the internal audit staff. They unlock the selling nation's compartment using a complex system of padlocks, combination locks, and auditor seals. They physically extract the heavy gold bars. They load them onto specialized carts. They then push the carts down the hall and deposit the bars into the compartment assigned to the buying nation. This process requires meticulous attention to detail. Gold deposits at the New York Fed are not considered fungible. When a central bank deposits a specific gold bar stamped with a specific serial number and a unique refiner mark, it maintains ownership of that exact bar. The New York Fed does not verify the metallurgical purity or the fineness of the gold. It simply weighs the bars and ensures that the exact bar deposited is the exact bar that is eventually transferred or withdrawn. This system of earmarking allowed the global gold market to function rapidly and securely. It created a perfect illusion of fluid capital movement across borders. In reality, the physical metal rarely saw the light of day. It simply migrated from one steel cage to another deep beneath the streets of Manhattan. The economics of this storage system were highly appealing to international clients. The Federal Reserve Bank of New York does not charge any recurring storage fees for the gold sitting in its compartments. Instead, it recovers its operating costs by requiring account holders to maintain a minimum uninvested cash balance. It also charges a simple handling fee for physical transactions. For example, if a central bank wishes to deposit a new bar into the vault, the New York Fed charges a processing fee of $2.70 per standard bar. If ownership is transferred internally through earmarking, the fee is a mere $1.26 per bar. This incredibly low-cost structure helped ensure the Manhattan Vault remained the undisputed center of global gold custody. In contrast, the Bank of England operates with a different economic model. The London Vault charges a daily storage fee based on the volume of gold held. Central banks storing gold at the Bank of England pay a nightly charge of roughly 3.5 pence per bar. For a nation holding 100 tons of gold, this translates to an annual storage cost exceeding £100,000. However, central banks willingly pay this fee. Paying for storage in London grants the depositing central bank immediate proximity to the London bullion market. This physical proximity ensures frictionless participation in gold trading, lending, and swaps. Chapter 4. The Collapse of the Peg and the Nixon Shock. By the early 1960s, the Bretton Woods monetary system began to show severe signs of structural strain. The United States was running massive balance of payments deficits to fund expensive domestic social programs and the escalating war in Vietnam. This excessive deficit spending pumped surplus dollars into the global economy. Foreign nations began to sense that the dollar was becoming significantly overvalued. Acting rationally, they began to aggressively redeem their surplus paper dollars for physical gold from the United States Treasury. American gold reserves began to drain at an alarming rate. To prevent the total depletion of the national treasury and to defend the official peg of $35 per ounce, a consortium of major Western central banks took coordinated action. In 1961, 8 central banks formed the London Gold Pool. The members of the London Gold Pool agreed to pool their physical gold resources. They intervened directly in the open market. They sold physical gold whenever speculative demand threatened to push the free market price above the official rate of $35. This arrangement was one of the most ambitious cases of central bank market cooperation in global history. For several years, the gold pool successfully stabilized the market. However, historical precedents show that market manipulation through technical cooperation eventually fails if underlying domestic economic policies are misaligned. The United States refused to curb its inflationary monetary policies. The United Kingdom faced severe, compounding currency pressures. In November of 1967, the British government was forced to devalue the pound sterling. This specific event acted as a massive catalyst. The devaluation proved that major currencies could fall. It sparked a massive tidal wave of speculative demand for gold across the globe. The participating central banks could no longer afford to bleed their physical reserves into the open market to suppress the rising price. The losses became unbearable. By March of 1968, the London Gold Pool collapsed completely. The dramatic failure of the gold pool offers a critical lesson that resonates deeply in modern financial markets. It demonstrates that central bank interventions, no matter how well coordinated or well funded, cannot indefinitely suppress market forces if the underlying fiscal and monetary fundamentals are unsound. The final, fatal blow to the international gold system came a few years later. In the summer of 1971, the United States faced an accelerating, unmanageable run on its remaining gold reserves. On August 15, 1971, President Richard Nixon addressed the nation. He unilaterally suspended the direct international convertibility of the United States dollar into gold. This historic event, forever known as the Nixon Shock, severed the final structural link between fiat currency and the golden anchor. Gold was now free to float on the open market based on supply and demand. The era of pure fiat currency had officially begun. Chapter 5. The $42.22 Anomaly, an Accounting Paradox. Following the total collapse of the Bretton Woods system, the United States government made a final minor legislative adjustment to the official price of gold. In 1973, Congress passed legislation establishing the statutory price of gold at $42.22 per fine troy ounce. Remarkably, more than half a century later, that specific statutory price has never been updated. This legislative stagnation has created one of the most glaring and fascinating accounting anomalies in the entire history of global finance. Today, the United States Treasury Department continues to hold approximately 261 million troy ounces of gold. This massive stockpile makes the United States the largest sovereign holder of gold on the planet. By law, this entire stockpile is recorded on the government's official balance sheet at the 1973 statutory price of $42.22 per ounce. As a result, the official book value of the United States Gold Reserve sits at roughly $11 billion. However, the reality of the modern open market is drastically different, with physical gold trading at modern market rates that often exceed several $1,000s per ounce. The true market value of the American gold reserve is well over $1 trillion. This monumental discrepancy means that the United States government is quietly sitting on roughly $1 trillion of unrecognized, unrealized equity. There is a clear historical precedent for adjusting this value. President Roosevelt did exactly that in 1934 to generate a massive capital surplus during the Depression. In current times, policymakers and economists occasionally debate the idea of a formal gold revaluation. Under international accounting standards, many global central banks now mark their gold reserves to current market prices. This practice accurately reflects a nation's true financial strength on the global stage. If the United States were to update its statutory pricing to reflect market reality, the Treasury could theoretically issue new gold certificates to the Federal Reserve. This action would monetize the massive capital gain. It could instantly fund government expenditures or retire portions of the national debt without issuing any new Treasury bonds. Yet, for now, the $42.22 anomaly remains untouched. It is a fascinating quirk of financial history, freezing the government's books in a bygone era. Chapter 6: The Fiat Wilderness and the Mechanics of Working Gold. Through the 1980s and 1990s, global financial markets fully embraced the new floating fiat currency system. During this era, gold was widely dismissed by mainstream economists as a barbarous relic. Advanced economy central banks, particularly those across Western Europe, became aggressive net sellers of their gold reserves. They viewed the metal as a dead asset. It generated no yield and cost money to safely store. Reserve managers vastly preferred to hold interest-bearing United States Treasury bonds instead. The selling became so pronounced that it threatened to crash the global gold market. This prompted several central banks to sign the Washington Agreement on Gold in 1999.39. This agreement successfully coordinated and capped large, price-moving gold sales by sovereign entities. Despite this broadly bearish sentiment, central banks did not completely ignore their remaining stockpiles. They engaged in the sophisticated financial practice of working gold to generate a return on their otherwise dormant assets. This was achieved primarily through the complex mechanics of gold swaps and gold leasing. The gold lending market operates quietly as an over-the-counter market. It is facilitated largely by major bullion banks located in London. The mechanics work as follows. A central bank can lease a designated portion of its gold to a commercial bullion bank for a specified period. The bullion bank pays the central bank an interest rate. This rate is known in the industry as the gold lease rate. Once the bullion bank has leased the metal, it sells the physical gold into the open market. This metal usually flows to meet the constant demands of jewelry manufacturers or technology companies. To hedge its position, the bullion bank simultaneously enters into a forward or futures contract to buy the gold back at a later date. When the lease expires, the bullion bank secures the metal and returns it to the lending central bank. Another vital mechanism used by reserve managers is the gold swap. A gold swap involves the temporary transfer of gold in exchange for a hard fiat currency. The parties agree to reverse the transaction at a set forward price on a specific date. This mechanism allows central banks to instantly acquire short-term foreign exchange liquidity. They can use this liquidity to manage currency stability and intervene in foreign exchange markets without permanently selling off their sovereign gold reserves. Through these highly specialized financial instruments, central banks successfully transformed a static physical asset into an active, yielding tool for liquidity management. Chapter 7: The Global Financial Crisis and the Repatriation Movement. The complacency of the fiat era was violently shattered by the global financial crisis of 2008. The near collapse of the international banking system forced central banks to fundamentally reevaluate their heavy reliance on paper assets and counterparty risk. By the year 2010, the prevailing trend of the previous 2 decades had entirely reversed. Central banks abruptly ceased selling their gold. They became net buyers on an annual basis. Simultaneously, a profound crisis of trust began to emerge regarding the physical geography of global vaults. For over half a century, nations had comfortably stored their sovereign gold in New York, London, and Paris. But in the direct aftermath of the financial crisis, domestic political pressure mounted. Citizens and politicians expressed a growing unease about the security and accessibility of foreign custody. This geopolitical anxiety prompted a massive shift in policy. It marked the beginning of the Great Gold Repatriation movement. The modern repatriation trend was heavily catalyzed by Germany in 2013.42, facing intense public scrutiny and demanding greater transparency. The German Bundesbank initiated a highly publicized program to bring a substantial portion of its national wealth back home. Between 2013 and 2017, Germany successfully repatriated 674 tons of gold. This metal was retrieved from the deep vaults of the Federal Reserve Bank of New York and the Banque de France in Paris, moving the massive stockpile directly to Frankfurt. Other nations quickly observed this action and followed suit. The Netherlands repatriated a significant volume of its gold from the United States. In more recent times, countries like India began moving hundreds of tons of their sovereign wealth out of the United Kingdom and back to domestic soil. This movement represented a fundamental rethinking of the post-World War II financial order. Storing gold abroad was no longer seen primarily as a symbol of international cooperation. It was increasingly viewed as a potential strategic vulnerability. Chapter 8: Moving the Metal: Logistics, Security, and Sovereign Immunity. Repatriating hundreds of tons of gold is an exercise in extreme logistical complexity. Unlike the digital transfer of fiat currency, which happens in milliseconds across fiber optic cables, moving physical metal requires military-grade security protocols and highly specialized infrastructure. When a sovereign nation decides to physically transfer its gold across borders, it cannot rely on traditional shipping. It relies on a highly niche sector of global logistics dominated by specialized operators like Brinks and Malcolm. These companies act not just as transporters, but as trusted custodians of immense value. They manage every aspect of risk from the exact moment the gold leaves a subterranean vault until it arrives safely at its final domestic destination. The logistical choreography is intense and highly secretive. Gold bars are loaded into specialized, tamper-evident containers. They are transported via heavily armored vehicles. These trucks adhere to strict European ballistic resistance standards, such as the BR-7 rating. This specific rating ensures the vehicles can withstand attacks from armor-piercing munitions. For overseas transport, physical gold must take to the skies. Transporting sovereign reserves requires chartering dedicated air freight flights. Weight is a severe limiting factor in aviation. A standard London good delivery gold bar weighs approximately 27.5 pounds. Because airplanes have strict maximum payload capacities, moving hundreds of tons requires dozens of separate, highly coordinated flights. Throughout this entire process, chain of custody documentation must be flawless. Responsibility is legally structured across defined control points. Insurance policies for such astronomical values are meticulously crafted to cover risks ranging from organized theft to natural disasters. The sheer financial cost, physical danger, and logistical complexity of physical transfer highlight exactly why the practice of earmarking was so heavily favored for decades. It also underscores just how determined modern nations are to regain physical possession of their assets. The fears driving this massive repatriation movement are not unfounded. Storing a nation's gold in a foreign vault introduces profound legal and political risks. Historically, international law has recognized the principle of sovereign immunity. This principle generally protects the assets of foreign central banks from being seized or attached by the courts of a host nation. However, in recent years, this legal shield has been severely tested. The outcomes prove that physical custody is ultimately a matter of political reality. A glaring precedent was set by the complex legal battle over Venezuela's gold reserves. In 2019, the Central Bank of Venezuela sought to access roughly $2 billion worth of its sovereign gold held in custody at the Bank of England. The Bank of England flatly refused the withdrawal request. The refusal stemmed from a severe political crisis within Venezuela. Two rival politicians, Nicolás Maduro and Juan Guaido, both claim to be the legitimate president of the nation. Because the United Kingdom's government officially recognized Guaido as the interim president, the English courts applied a legal doctrine known as the one-voice principle. The courts ruled that the Bank of England could only accept instructions from the board appointed by the government officially recognized by the United Kingdom. This landmark case demonstrated a vital, terrifying lesson for central banks worldwide. Physical custody dictates ultimate control. If a depositing nation falls out of diplomatic favor with the host nation, its sovereign gold reserves can be effectively frozen through legal and political mechanisms. This realization fundamentally altered the risk assessment protocols for sovereign wealth management across the entire globe. Chapter 9: Weaponized Finance and the Modern Gold Rush. The concept of geopolitical financial risk reached a boiling point in early 2022. Following Russia's invasion of Ukraine, Western nations utilized their control over the dominant dollar-based financial system. They froze roughly $300 billion of Russian foreign exchange reserves. For central banks operating in the global south and emerging markets, this action was a stark, undeniable demonstration of the vulnerabilities inherent in holding fiat currency reserves. If a major global military power could have its digital wealth neutralized overnight by foreign decree, no nation's reserves were truly safe. The only protection was to hold reserves in physical, sanction-proof assets. This geopolitical reality triggered a massive structural shift in the global gold supply chain. Central banks embarked on a historic buying spree. They purchased a record 1,136 tons of gold in 2022. They followed this with over 1,000 tons of purchases in both 2023 and 2024.59 nations like China, Poland, India, and Turkey led this unprecedented institutional accumulation. Furthermore, the methods used to source this gold have rapidly evolved. The traditional supply chain relies on purchasing standard London good delivery bars. These bars are sourced from major bullion banks operating on the secondary market. However, central banks are increasingly innovating to secure metal completely outside of traditional, dollar-dominated channels. Many central banks are now directly integrating domestic production into their sovereign reserves. Institutions in countries like Ecuador, the Philippines, and Uzbekistan have established official programs to purchase unrefined gold directly from local artisanal and small-scale gold miners. By purchasing domestic output using their own local currency, these central banks can accumulate significant gold reserves without depleting their valuable foreign exchange dollars. The central banks then utilize specialized local refiners to upgrade this raw metal to international purity standards. This seamlessly expands their sovereign wealth while simultaneously supporting their local mining economies. It is a closed-loop system that totally bypasses the international fiat network. Chapter 10: The Crossover Milestone and the New Reality. The aggressive accumulation of gold over the last few years has culminated in a remarkable financial milestone. By the year 2025, for the first time in several decades, central banks globally held a larger share of their overall reserves in physical gold than in United States Treasury bonds. This historic crossover signifies the total fracturing of the financial narrative that dominated the late 20th century. Gold is no longer viewed as a barbarous relic of the past. It has been entirely rehabilitated as a high-performing, strategic asset essential for national survival. Its price has surged to record highs. This price action has fundamentally altered the economics of global reserves. It has proven its enduring utility as a hedge against inflation, counterparty risk, and rapid geopolitical fragmentation. The story of global gold reserves is a powerful testament to the enduring reality of physical wealth. From Isaac Newton's early mint ratios to the massive construction of Fort Knox. From the secret, silent transfers inside the New York Fed to the heavily armored flights of the modern repatriation movement. Through all of this, the underlying truth remains entirely unchanged. In a modern world where digital currencies can be frozen by a political decree and fiat money can be diluted by endless printing, gold remains the ultimate sovereign anchor. It is the one financial asset that requires no signature. It relies on no government's promise. It answers to no authority other than the unbreakable laws of chemistry and human trust.